of our clients earned 20% tax-free by borrowing out of his IUL policy. In this episode, I'm going to address reason number 4 out of 5 to borrow money instead of withdraw money from an IUL policy. And by the end of this video episode, you will understand what an index loan is and how you can earn more than the cost to borrow. So, I'm Doug Andrew, and I've been helping people optimize their financial assets, minimize taxes now for more than 48 years. If you have watched any other educational episodes on this channel, Three-Dimensional Wealth, you may be aware that one of my favorite financial instruments, vehicles, that allows you to accumulate money totally income tax free and be able to access that money without triggering tax. And then when you ultimately die at the end of the day, whatever you leave behind blossoms and increases in value, and it transfers income tax-free to your heirs, is a maximum funded indexed universal life insurance policy that is structured correctly and funded properly. If it passes that test, it is deemed a laser fund. And that's the name of my most recent best-selling book I want to gift you at the end of this episode. So stay with me. I want to gift you a 300-page book. But this laser fund is a maximum funded indexed universal life structured correctly. I would dare say that over 99% of IUL policies owned by policyholders in America would not pass the scrutiny of a laser fund because they're not structured correctly or funded properly. When you do it, it will knock the socks off of other financial instruments like IRAs or 401ks invested in the market and so forth. And so if you want to understand why, look at other episodes. But in this one, I'm going to address reason number 4, that after you've accumulated money in an IUL policy, you don't have to wait till retirement to access money. I've had people access money 4 days after they put money in it. But most people have come to me for nearly 5 decades for accumulating money on a tax-favored basis that's safe, that's tax-free, so they won't outlive their money during their golden years. So let's talk about retirement. So many times people have come to me and maybe they started socking away $500 a month into an IUL policy and now they have $1 million accumulated after 30 years. Yep, you can do that earning what I've earned, an average of 9.6%. Tax-free. Many people come in and they have a lump sum of $100,000 a year or $500,000 and they don't want to put any more in. So they came in with $500,000 and we have to spread it out to comply with a tax citation, but let's keep this simple. They start out with $500,000 and many of them earning 9.6%. If you divide 9.6 into the rule of 72, your money doubles every 7.5 years. So do the math. 500,000 doubles to $1 million in 7.5 years. $1 million doubles to $2 million in another 7.5 years. $2 million doubles to $4 million in another 7.5 years. And $4 million doubles to $8 million in another 7.5 years. Now they have $8 million tax-free. And you will read in the book I'm going to give to you how they can pull out 10% a year without depleting principal. $8 million generates $800,000 a year of tax-free income. And people say, why is it tax-free? So in this series, this little mini series, this is reason number 4 why you want to borrow money out of an IUL policy instead of withdraw it. So make sure you watch the other episodes. But if you withdraw money, after you've recovered your basis, in that example, after you've pulled out, the first $500,000, now you're going to trigger unnecessary tax. That's dumb. The IRS says do it the smart way. Borrow. Why would you borrow? Because loan proceeds are not deemed earned passive or portfolio income. When you borrow money for a car or for a house, you don't have to pay tax on that. If you borrow money out of your insurance policy, you don't have to pay tax. It's tax-free. Must charge you the minimum statutory interest rate. Now, recently, with low interest rates, that's been like 2%. So they can charge you 2% and it's tax-free, but they can credit you 2% on the money that you left in the policy that collateralized the loan. If you have $1 million in there or $8 million, it doesn't matter. If you borrow the equivalent of your interest, it's tax-free, but that means your balance is going to keep growing, and the insurance company can do a zero wash or zero cost loan, which is reason number 3 if you've watched that episode. But that's not what most of my clients do. Most of my clients, they're business owners, they're savvy. They understand how money works. So get a load of this. They actually can borrow, instead of at 2% and being credited to a zero wash or zero cost loan to have it be tax-free, they use an index loan, and it's sometimes called a participating loan. Let's talk about this and why they are called participating or index loans. It means the insurance company will charge you a little bit higher interest rate, maybe 4 or 5% instead of 2%. Why would you pay that? Again, the loan is not due and payable during your lifetime. They deduct the loan interest from your accumulation account that is growing since you are not withdrawing money. And I'll give you an example here in just a moment on how this works. When they're doing this, they can charge you a higher interest rate, but then they will credit you on all of this cash value that you're not withdrawing. You're leaving it there to grow. They'll credit you or let you participate on 100% of that money in the market. With indexing, you get to participate when the market goes up and not lose when it goes down because your money's not really invested in the market. That's indexing. What does this mean? I've had clients who borrow at 5% and they get credited 7. They borrow at 5, they earn 10. How much more is 10 than 5? Don't say 5, it's 100% more. In other words, would you hire an employee for 50 grand that made you an extra 100 grand? Yeah. That's called a 100% return on employment cost. So you could borrow $100,000 or $1 million out of your IUL policy. They'll charge you 5%. That might be $50,000, but they credit you 10%, $100,000. $100,000 minus 50 is you made 5% tax-free. You made 50 grand tax-free on your money while you were using your money for something else in your business or whatever. Is this making some sense? You need to get a copy of my book that I'm going to gift you here in a moment. If this is already intriguing you, I would strongly recommend you subscribe to this channel. I have over 730 educational videos, and it's free when you subscribe. So just click subscribe and click the little bell when you do. Why? Because then you'll be notified every time I post a new video, which I do almost on a daily basis. But be sure and click like or post a comment or share it with somebody who ought to watch this episode. So let's come back and connect the dots for you on participating or index loans. This is going to blow you away. And stay with me. I want to gift you a copy of my book here at the end. There's a term called arbitrage. Sounds weird, doesn't it? No, it's what makes the world go round. What's arbitrage? It's when banks borrow your money. When you put money in a bank, in a savings account, they pay you 1% interest. Are they just a benevolent institution paying you interest? No. What are they doing with your money? It's not in a vault. They're loaning it back or investing it out. In fact, they invest 30 to 40% of their tier 1 assets into insurance companies. So just bypass them. But they're paying you 1 and they turn around and earn 5% loaning it back. They make $50,000 in interest on every million that they only have to pay $10,000 to you. They're making 5 times. Can you do this? Yes. So our savvy clients, they use index loans, which means they will say, well, you can charge me 5% or 4% on the money I borrow. If I borrow $100,000 a year or $1 million a year, and you can change any year you want, but go ahead and charge me 5%, 50 grand on my $1 million loan out of my policy. But now the million that is collateralizing the loan is going to get credited with whatever the index rate is for the year. Yeah, maybe it doesn't earn very much some years, but other years it can earn 10%, double. But in 2017, I had a client, a real estate investor. He's very savvy. He needed $1 million for an earnest money to tie up a big apartment complex. And he calls up and says, Doug, I need one of those forms. I need to borrow $1 million out of my policy. And so I send him the form. And of course, it's one page. He puts his name and his policy number on there. He doesn't check the box, I want to withdraw $1 million. He checks, I want to borrow. Well, do you want to borrow at 2% and be credited 2%, the zero wash loan? Or do you want to borrow at 5% and we'll credit you whatever the index rate is earning? That's the one he checks. In 2017, he did that. He borrowed $1 million at 5%. That's $50,000. He didn't have to make out a check for that. That was deducted because he earned 25% on the $1 million that was collateralizing that loan. That's $250,000 tax-free. 250 minus the 50 means he made 20% or $200,000 tax-free on his $1 million in his policy, while he was technically using that $1 million to tie up a piece of real estate where he made $3 million by fixing up and flipping this apartment complex. If this is blowing you away, you need to learn more, okay? So this is where you can borrow at 5 and earn 10. You can borrow at 5 and earn 25. There were people in 2021 that borrowed at 5 and earned 61%. They borrowed at 5 and earned 153%. That is the smart way to access money. It's called an indexed or participating loan. You don't have to do it all the time. If you're worried that we're headed for a recession, you just go back to the zero cost loan where they charge you to and credit you to. But any year you feel bullish about America, I would recommend you access it the smart way with an index loan. Want to learn more? Here's how. Claim your free copy of this 300-page book, The Laser Fund, How to Diversify and Create the Foundation for a Tax-Free Retirement, and how to be able to have $1 million nest egg, generate $100,000 a year of tax-free income. But when you take it out, it's the smart way where maybe they are charging you interest, but you're earning way more because you are becoming your own banker. You understand how money works. This will allow you to get 2 and 3% higher payouts than if you just take money out the dumb way. Okay? Claim a free copy by going to laserfund.com. Click on the link below. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost and I'll pay for the book. It's 2 books in one. This side is about 200 pages, 14 chapters, all the charts and graphs. If you're more of a right brain learner, you flip it over and read this one. 100 pages, 12 chapters with 62 actual client stories. But claim your free copy now. This will empower you. There's options there to listen and learn, watch and learn. There's even an 18-hour masterclass that my 2 sons and I recorded that dives way deeper than the book does. But this is about your brighter future.